Okay, so the primary things that we're going to be focusing on here is going to be break-even analysis. And we're going to be starting to analyze how many units do we have to sell in order to be able to break even. And we're going to be seeing that in making that analysis, we're going to have to cover first our variable cost, and then anything that is left over is considered a contribution margin. That contribution margin will first go towards our fixed cost, and then anything that's left over is going to go towards our profit. Okay, so we go ahead and we take a look. Okay, and we can consider the situation where a company has a sales price per unit of, say, $100. Make it even easier, $10. The variable cost per unit are going to be, say, $7. So we're going to end up with a contribution margin per unit here of what? $3. And that contribution margin per unit is first going to have to go to cover my what? Fixed cost. And then if there's anything left over, it's going to go towards my profit. Okay? So what happens? If this company had a fixed cost of, say, $300,000, and we have a contribution margin per unit, of this $3, the question becomes how many units would they have to sell to break even? And so the way we will set that up is we'll take the contribution margin per unit, which is $3, contribution margin per unit, which is $3, and we'll multiply that times the break-even units. That has to equal what? Fixed cost in order for me to have a what? Zero profit, for me to break even. Okay? So I go ahead and I do what? I just set that up. 3 times my break-even units, whatever that is. My fixed cost is how much? 300,000. I take that what? Just simply do the algebra there. Break-even units, therefore, equals 300,000 divided by what? Divided by the 3, just doing the algebra. So that means that my break-even units is how much? Is 100,000. So if I sell 100,000 units, then I can go ahead and break even. Now, if you're looking at this and you're saying, well, you have to sell, 100,000 Porsches to break even, well, that's not going to be too great of a business proposition for you, right? But if you're in a situation where it's 300,000, I don't know, clothespins that you have to sell, well, maybe you can actually have the capacity in the factory to generate those 300,000 clothespins or whatever to be able to break even. Okay, and so you would make that decision at that point as to whether or not you want to move forward. Okay, so that's just an overview here, but when we look at our contribution margin is first going to cover our fixed cost, and then it's going to what? Contribute to our profit, our income after that. That's what we mean by contribution margin. First contribute to our fixed cost, then our income. Okay, now we've seen that contribution margin is our sales minus our variable costs. Variable costs change with the level of production, don't they? And so as I produce units, I have to cover that variable cost right out of the gate to have anything left over for a contribution margin, right? So I take my sales minus my variable cost. That gives me my contribution margin. Now, if I want the contribution margin per unit here, then what? Then I can either take, like I just showed you on that opening slide, take my sales price minus my variable cost. That'll give my contribution margin per unit. Or I could simply take what? The entire contribution margin, which is my sales minus my variable cost, and divide that by the number of units. That will also give me the contribution margin per unit, right? Okay, so we've got a couple different ways that we can calculate our contribution margin per unit. Now, just taking a look as to how we set up a break-even analysis, okay? And again, the way I set these up, I say my contribution margin per unit times my break-even sales in units. This is frequently the unknown in these questions, right? Because they want to say, well, how many units did you need to break even? I set that up equal to my fixed expenses, fixed costs, whatever, and then I simply do the algebra, which is to do what? Take my unit, to get my unit sales, take my contribution margin per unit, divide it by the fixed cost, right? And that will give me my break even in units like we saw on that previous example. Now, a lot of times students just want to memorize this because they figure, well, I'm just going to memorize this and this is how I'm going to, get a good grade on the exam. Meanwhile, if you do this, all of a sudden they give you a question that just kind of tweaks the fact pattern a little bit and you can't hang with it, okay? So what you need to do is you need to set it up every single time, no matter how stupid it seems to you or waste of time it seems to you to set it up the way I'm doing it. Set it up like this every time. If you want to break even, contribution margin per unit says what? How much of each sales dollar first goes towards fixed cost and then my profit. You set that up. You'll always be solving for the units. Divide your contribution margin per unit into your fixed expenses. That's going to give you the break even in units, right? Always set it up like that. Don't just plan on remembering that last part there, okay? Set them up the same way every time. Okay, so you come over and we use an example here where this company is selling, and I guess they're selling bikes in this example, and they have a what? They have a sales price per bike of $500. They have variable cost per bike of $300. Can we sell a bike if we don't incur the variable cost? We cannot sell that bike if we don't put the materials in that bike, if we don't sit there and what? Put the direct labor in there, and if we don't sit there and incur any variable manufacturing overhead, right? We got to incur those variable costs to even have a bike to sell. So we always take the variable cost per unit off of the sales price, meaning we're left with $200 per bike to cover our fixed costs, right? Okay, and so if our fixed costs are $80,000, and we say in this example, how many units will the company need to sell to break even? We first set it up, which is what? My contribution margin per unit times my break even units. I circled that because that's what we're always looking for in these problems, or often looking for in this problem. Set that equal to my fixed cost. Contribution margin per unit, $500 sales price minus the $300 variable cost gives me a contribution margin per unit of $200, right? I go ahead and I set that up. $200 that are left to cover my fixed cost after I've, made my bike, so I have a bike to sell, times the break-even units, got to equal fixed cost, right? I go ahead and I do the algebra. I take the 80,000, I divide that by the contribution margin per unit. I have to sell what? 400 bikes just to break even, don't I? Okay. Now, sometimes you'll want to know, well, what is that in dollars? And you simply take the number of units, 400 units in this example, times the $500 per unit sales price, and that turns those units into dollars, doesn't it? If you wanted to quote the number of dollars you need to break even. Okay. Now, just to sort of prove that in a contribution formatted financial statement, notice that we take our sales price, which is 400 bikes, times what? 500 per bike means we're going to generate, we've already seen 200,000 in sales, right? We have to cover our variable costs so we even have some bikes to sell. That's going to be 400 bikes times $300 variable cost per unit, that's 120,000, isn't it? Right? Which means we have a contribution margin of 80,000. You subtract out the fixed expenses of 80,000. Did we break even? Do you have an operating income of 0? Okay, that's just proving what we just looked at, and that's just looking at, and they call this a contribution formatted income statement. This is not something, by the way, guys, that we give externally to companies to look at. Remember, the income statement externally that you learned about in Accounting 100 was, if you were talking about the multiple step, you had sales minus your discounts, minus your returns, gave you net sales, minus what? Minus my cost of goods sold, gave me gross profit. Then I took off my operating expenses. That gave me operating income. Then I took off my non-operating expenses like interest and gains and losses on sale of equipment, and that gave me net income, right? Okay, that is a different format than what we're using here. We use this format for internal purposes because look how quickly you can do analysis with this by saying, okay, what happens if I change my fixed cost? What happens if my variable cost changes, etc. So this is a much more readily usable for internal analysis. Okay, now let's take a look and think about the concept of target profit, because we are not going to business school. Where you are right now, you are not here to break even. You are here to make a profit. Why do I want to make a profit? Why do I want to make a profit? Because I got to buy a Porsche or something, right? I mean, I want some nice stuff hanging around my house. I'm not here to break even, right? Okay, so what happens? I want to sit here and I want to make a profit. So all I need to do to figure out how much sales I have to generate to make a profit is add that target profit to my fixed cost. I'm essentially doing what? Increasing that hurdle for myself, right? But hey, if all I'm going to get out of this business is breaking even, at least in the long run, I'm not going to do this. Maybe for the short run, I'm okay with breaking even, but eventually I want to turn a profit on this, don't I? Okay, so if you want to figure out how many units you have to sell to get the target profit, you just add the target profit to the fixed expenses, and then the rest of the calculation is the same, right? Okay, so you go ahead and you take a look at this little example that we were just looking at where we had, what, 80,000 of fixed costs, and this company wanted to turn a profit of 20,000. They simply added that to the fixed expenses, and they divided that by the contribution margin per unit, because remember, contribution margin first goes towards fixed expenses, and then if there's anything left over, it's got to go to profit, right? And when you do that calculation, they tell us, hey, you got to sell 500 bikes to get that target profit of 20,000. Now, if we put that back into the contribution margin formatted financial statement, 500 bikes, how much per bike? $500 per bike, that's 250,000. Variable costs are $300 per bike. 500 bikes, that's 150,000 of variable cost. There's my contribution margin now, which is what? 100,000. 80,000 first goes to fixed expenses, 20,000 left over. So this analysis works, doesn't it? Okay. Okay, good. So we go over and let's take a look at a couple of these questions. And guys, there's 2 files on iLearn now for your questions. The first file that I've had there for some time, I went ahead and just embedded the questions into the slides. The second file are just standalone questions by themselves, and we're going to go through all of that tonight. We're going to go through these questions. We're going to go through the ones that are in the separate file tonight. Okay, so let's just go through these, and let's take a look now. And they tell us that they ask us the break-even in units sold will decrease if there is an increase in what? You can see the answer is selling price, right? But what I put over here on the side is I just went ahead and took the example we were just looking at and did what the problem told me to see if it was true that the break-even in units decreased. So I moved the sales price. It was 500. I changed it to 550, didn't I? Did I increase the sales price? I increased the sales price. I took the what? I took off, I don't know what VV is, variable cost, VC. I subtracted the variable cost from that. That gives me what? $250 per unit is my contribution margin. I set the problem up the same way every time. I take my contribution margin per unit times my break-even units, set that equal to my fixed cost, and the problem we were just looking at was 80,000, wasn't it? And when I go ahead and I do the algebra, they tell me that what? They tell me that my break-even units is 320. Did the break-even in units come down? It came down from what? From 400 to 320, didn't it? Why? Because I'm getting more sales price. I'm getting more of a contribution margin per unit towards first my fixed cost, then my profit. So I don't have to sell as many units if I increase the sales price, right? Okay. Okay, good. So you come over and you take a look at this one. And this one now is a situation where they tell us what the contribution margin is, sales minus variable expenses for 6,200 units, and then they want to see what would happen if what would our contribution margin be if we sold, what, 5,800 instead of 62? Now, if you look down here at the way the textbook kind of showed the solution, they're kind of walking you through this slowly so that you're understanding exactly what's going on. They're taking the sales price per unit. They're coming up with the variable expenses per unit by taking the total sales, dividing it by the 6,200 units, the variable expenses, dividing it by the 6,200 units to come up with the variable cost per unit. They then take the selling price per unit minus the variable cost per unit, gives them the contribution margin per unit. Okay, when you're taking the test, that is a waste of time to do all that. If they're sitting there and they're giving me the contribution margin set up there, then I'm going ahead and I'm taking that contribution margin and I'm dividing it by the number of units that they indicated to me here that generated all this. So I know that I have a contribution margin per unit of what? $9, don't I? I then go ahead and I multiply that by the addition, the different, it's not additional, it's less, the new number of units that they're saying they're going to sell here, and my contribution margin then would be 52,200, wouldn't it? Okay? Okay, good. Come over. Let's take a look at this question. And for this one, they say if the company sells 4,700 units, what would be the contribution margin? Again, guys, I'm not going to go through all these steps. The more steps you have, the more chance you're going to make a mistake, right? If you can sit there and break it down to one key step, just take the contribution margin and then what? Divide that by the number of units. That gives me a contribution margin per unit of $19 per unit. And they told me here that they're going to sell 4,700 units. So $19 per unit times the 4,700 gives me this contribution margin of 89,300. Okay. Now, I'm not giving you questions like that on your exam. All this was like, okay, I'm loose now, right? Now I'm ready to start really figuring some things that are going to be more like your exam. Okay, so this is not something I'm going to give you. I just want you to get used to messing around with these numbers in these first couple of questions. Okay, more like what I'm going to give you in the exam is something like this. What is the break even in units using this fact pattern? So they tell me that the sales price is what? $230 per unit. Put in that sales price. They tell me that the variable cost is $66.70 per unit. I can't sell one item unless I cover those variable costs, right? So I got to take that off, and after I have produced the units that I need, I am left with what? With a contribution margin of $163.30 that is going to first go to cover my fixed expenses, and then what? Then any profit, right? Okay? And so I go ahead, guys, and I'm telling you, you need to set them up like this every single time. If you don't do that, I promise you, you're going to get stuck in the middle of a problem and not understand what's going on with it. If you set it up like this will always keep you grounded to where you're going to be able to answer the question correctly. It seems like a nonsense, wasted time step until you're in the middle of a crisis, and then you're like, I don't know how to answer this question. If you go back to this, This will save you. Okay, so you set it up. Contribution margin per unit times the break-even sales equals my fixed cost. My contribution margin per unit is what? 163.30. I'm solving for the break-even units, and I have to cover fixed cost of $212,290, this problem told me. So I take the $212,290, I divide that by my contribution margin per unit. I have a break-even of how many units here? 1,300, right? Okay. Okay, good. If we are sitting here and we are doing another problem, this is just asking me for my break even again, isn't it? So I take my what? Sales price per unit minus my variable cost per unit, gives me contribution margin per unit. I always set this thing up every time. Contribution margin per unit times my break-even sales has to equal my fixed cost, right? I go ahead and I do the algebra on that. $18 per contribution margin times my break-even sales. Got to equal fixed cost of $82,800, the problem told me here. And so my break-even sales is what? Do the algebra, divide each side by my contribution margin per unit. And so I'd have to sell what? 4,600 units to break even here. Question? Okay, good. Let's go ahead and let's see what happens if they throw in a target profit. Ooh, that's going to be hard. What? Break even contribution margin per unit is what? The 190 sales price minus the 9120 gives me what? 98.80 per unit. Okay, 98.80 per unit, and then what? I'm going to sit here and set up my problem. Contribution margin per unit times my, and now I'm calling it target profit sales, has to equal, and it has to equal my fixed cost plus what? Plus my target profit here is $16,000, doesn't it? So I just add the target profit to my fixed cost, and so now I'm saying my 98.80, which is my contribution margin per unit, times my what? Times my target profit sales will equal my fixed cost plus, and I added in my target profit, didn't I? And when I go ahead and I do the division on that, I take my 440,840. I divide it by my contribution margin per unit, $98.80 means that my what? My target profit units here are 4462. Did that come out perfectly? 4462? Did 440,840 divided by 98.80 come out exactly to 4462? What'd you get? 4461.9 and 94. So we rounded up, didn't we? In these questions, always round up. Always round up, because I can't sell a fraction of a unit. Nobody's going to say, oh, okay, yeah, give me a 0.2 of a unit, right? And if I'm below my break even, I'm not going to break even, right? So in these problems, you always round up to that next bigger number. I'm never going to give you a problem, though, guys, where you have to decide between, one unit because of rounding. It'll always be very clear to you, what the right answer is. But I'm just pointing out to you that we always round up in these problems to that next whole unit. Okay? Okay, good. All right, now we could graph this if we want to, and we can graph this by what? By sitting there and starting with our fixed cost. We bring in our variable cost per unit, which brings up our total cost by the amount of variable cost here, doesn't it? Right? Then we graph our sales line across that, and when our sales exceed our total cost, we're in our profit zone, while our sales are below our total cost, we're in the loss zone, aren't we? And obviously we're break even at the intersection of these. Okay? Okay, good. let's go ahead and talk about something called contribution margin ratio. Contribution margin ratio says what percent, how many cents. It's the same thing, because sometimes I'll get to say, is it the cents or the percent? It's the same thing, okay? 1 penny is 1% of a dollar. 5 cents is what? 5% of a dollar, right? Okay, so it's the same thing, okay? What percent, how many cents, what percent, let's just say it that way, of each sales dollar goes towards my fixed cost and then my target profit. We call that contribution margin ratio. Now, it is the easiest little thing in the world to calculate. You simply do what? You simply take your contribution margin. It's right here, John. You don't even have to rewrite it. You take your contribution margin and you do what? Divide it by your total sales. Did that give me the 40%? Okay. Is there another way to calculate this? How about this one? If you don't like big numbers, some people like big numbers. Some people like little numbers. When do you like big numbers? When you're getting paid. You like big numbers when you're getting paid. What? When you're doing calculations, sometimes smaller numbers are better, right? Okay. So if we sit here and we take the 200 contribution margin per unit and you divide that by what? $500 sales price per unit. Do you get this 40%? Do you get the same number? Okay, so there's our contribution margin ratio. Okay, they call that contribution margin ratio. Now, why do we care about this contribution margin ratio? Well, if we want the answer to come to us in dollars, we could simply sit there and say what? 40% of our break-even in sales dollars will equal our fixed cost in dollars. You divide each side by the contribution margin ratio, your answer is going to automatically come out in dollars, isn't it? So it saves us, if we want the answer in dollar, that step of having to multiply the number of units times our sales price to come up with a dollar amount. So it's just a way of getting your answer in dollars, isn't it? Okay, so let's just take a look. And we sit here and we have our contribution margin ratio, which we just calculated is our sales price divided into our contribution margin, and we can do that on a total basis or per unit. And we're sitting here and we're saying that, look, if we were going to try to get it in units first, we'd take the $200 times the break-even units equals 80,000. We divide what? We divide each side by my contribution margin per unit. That tells me that I have to get 400 units. We've already seen this, haven't we? And then we multiply that by the price, and it gives me what? Break-even sales dollars of 200,000. Or we could have just used the contribution margin ratio, which is what? Fixed expenses divided by the contribution margin ratio, using my break-even in sales dollars. But let's just set it up as what? Break-even sales dollars times my contribution margin ratio. 40% of every dollar first goes to my fixed cost and then my target profit if I had it, right? I go ahead and I do the algebra. I divide each side by 0.4, and I have to generate what? $200,000 in sales. It gives me the answer in dollars. I don't have to sit there and take the, contribution margin per unit and multiply by the number of units to get that to be turned into dollars, right? I mean, the sales price per unit and multiply it by the break even in units to get that to turn to dollars. It just automatically gives it to me in dollars, right? Okay, so we come over and we take a look at how it works for target profit, guys, and it's the same thing. You do what? You just add in the target profit. In this case, it's 80,000. Divide that by the contribution margin ratio. That's going to automatically give you the answer in dollars, doesn't it? Okay, so let's go ahead and let's take a look at a couple of examples here where they've given me the contribution margin ratio. They say that's 16%. They tell me that the fixed expenses are 44,000, and they say if the company sales are 299, what is the best estimate of their income? Okay, so what am I going to do? Again, guys, I like to set these up where I'm sitting there and I'm saying, well, look, I've got 299,000, don't I? And I know from this that what? 16% of each sales dollar is going to go towards my first fixed cost and then any profit, right? So if I take this 0.16 and I multiply it times my 299,000, I get what? 47,840? I'm kind of rewriting the solution here, but just so you see it in slow motion. 47,840 is the amount of the contribution margin, isn't it? Right? Since 16% of each sales first goes towards my fixed cost and then my profit. There's my contribution margin. I go ahead and I subtract off they told me the fixed expenses were how much? 44,000. That means that I should be left with this 3,840 for profit. Okay, and you can kind of see kind of rewriting the explanation. It's right there. But is that how that works? Okay. Okay, good. Let's go ahead and let's take a look at this next one now, which is this Garcia. Okay, and Garcia has what? Sales of 600,000. So I'm going to take my sales of 600,000 right there. Okay, my variable expenses are what? 120. That's that right there. So I know that my contribution margin is what? 480, right? Sales price minus variable cost. I divide that by my sales price. That gives me my contribution margin ratio, doesn't it? You say, well, why didn't you do it on a per unit basis? Because they didn't give me the units. That was their whole point. They wanted to force me into the contribution margin ratio by not telling me the units here, right? Okay, and so what happens? I go ahead, and again, guys, I'm telling you, set up these problems with the ratio, contribution margin ratio, same deal. Always set them up by saying, okay, contribution margin ratio times my break-even sales dollars has to equal my fixed cost here of 300,000, doesn't it? Divide each side by the contribution margin ratio, the way they did here, and this gives you now the break-even in sales dollars, and that was the only way I could have gotten this answer was by using the contribution margin ratio for this one. Hello? Question? Okay. All right, good. So we come over. I'm assuming that this is as easy for you as it is for me at this point, right? Because it's not that complicated. Okay, let's do another one. Contribution margin ratio is my contribution margin divided by my sales price. That gives me a 0.4 contribution margin ratio. Now, they want to know what would be the contribution margin if sales increased by 30%. So they're sitting there and they're saying the ratio of dollars, of sales dollars to contribution margin doesn't change just because the level of sales changes, right? That ratio stays the same. And so what happens? I'm sitting here and they say that sales increase 30%. The way you get an increase of 30% is you multiply that by 1.3. Sometimes students say, well, how does that work? Well, if it's an increase of 30%, 300,000 is 100%, and then what? If I multiplied the 300,000 by 0.3, I'd get 90. I add that to the 300, that's a 30% increase, isn't it? The way I like to do it is I just go ahead and I multiply that times 1.3. 300,000 times 1.3 equals 390 times what? Times my contribution margin ratio means that I would have 156,000 of a contribution margin if I increase my sales by 30%. Okay? All right, good. Come over and let's take a look and see how we might use the contribution format for our financial reports to help us to make different business decisions. which is this reason I assume that you're taking this class because you're a business major and you want to be able to make these kind of decisions, okay? And so what happens? We have this company that's selling these racing bicycles again, and the sale is $500 per unit, and they're thinking that they could increase the sales price per unit by $40 in order to do that, increase that by $40. They think they're going to have to spend $10,000 on an advertising budget. Should they do this? Should they do this? Huh? You want to run some numbers? Okay. Let's go ahead. Let's run some numbers. See what we come up with, right? And so what happens? We're sitting here and we have what? This is the current situation. $500 per bike, 500 bikes, right? Our variable cost. Our operating income's $20,000 if we stick with the current plan, right? If we do what this, genius, whoever who walked in with this plan says, we're going to, yes, increase our sales for the additional units, but what? Our fixed costs are going to go up $10,000, aren't they? So this was a bad idea, wasn't it? And the contribution margin format allows me to figure out very quickly whether or not I should do this. If I wanted to be even quicker about this, I could just use the contribution margin to figure it out. If I sell 40 more bikes and my contribution margin is $200 per unit, that means I'm going to have an increase in my contribution margin of $8,000, right? $40 per bike, $200 per bike, 40 bikes, right? And if I'm going to increase my advertising budget by $10,000, I can quickly see this is not a good idea because my increase in fixed cost is going to eat up my increase in my contribution margin, isn't it? So you could do a faster analysis that way. Okay, good. Let's see if we should go ahead and follow this idea now. And so now we're going to increase our sales from 500 to 580, and the way we're going to increase our sales is by getting the talk around the campfire to be that we have a better product. So we're going to use more expensive materials, which is going to increase my variable expense, but I'm thinking that now people will say, yeah, this is the bike of the century, you got to buy this thing, right? And I'll be able to increase my sale from 500 to 580. So what happens? I go ahead and I just do the analysis. This is the current situation. If I bump up my variable cost, it goes from 300 to 310. So my variable cost is now 179,800. But I've sold more, haven't I? I've sold 80 more. Okay. So what's going to happen? My contribution margin goes up. My fixed costs stay the same regardless of the level of production, at least within the relevant range. And I end up with what? An operating income increase, don't I? So that was a better idea, right? Okay. Let's see what happens if I cut my selling price $20 per unit, increase my advertising budget, and now I'm going to have a pretty nice jump in the amount of units that I sell. Let's see if that helps out. And again, the takeaway from these examples is simply what? Using the contribution format to the financial statements. So I sit there and my sales price goes from 500 to 480. I drop the sales price, right? So my sales will be 312,000. My variable costs are going to be 650 times the $300 per bike, right? So I'm left with a contribution margin of 117,000. My fixed expenses are going to go up 15,000 because I'm doing what? I'm doing that advertising campaign now, right? And when I look, I can quickly see that this is sort of looking like it's worth it in that what? My profit, my operating income is now 22,000 instead of 20,000, right? Okay. Now, what happens? Would you do this? If you were the company, would you do this? I mean, in a classroom, we say, yeah, do it because it increased to $2,000. Would you risk all this to generate $2,000? Huh? Well, yeah, we're going to produce a bunch of more bikes, right? That we're not exactly 100% sure if we can sell, right? So now we got a bunch of more inventory on our hands, don't we? And there's no guarantee that we're going to sell this 650. We're thinking if we drop the price we can, but we are going to incur more costs now, are we? And we're going to cough up more money for this advertising campaign, right? All in hopes of generating $2,000 more of operating income. Are you down with this?
That's for the first month, right?
Oh, I don't know. Is it 1 month?
If it's for 1 month, then yeah, because in the long term, it's
Where are we? I'm lost myself now in this slide, huh? I don't. Did they say? What is the profit if it cuts its selling price to $20 per unit, increases advertising budget for 15,000? Yeah, this is per month. So you're going to get 2,000 more per month. For what? How many months?
1 month.
That's 1 month. So how many months do you want to do this for? 12 months?
You do it for 12 months, but you like, I mean, is there like a percentage increase? Because with mass marketing, it's gonna.
Well, now they've said the number of more bikes is going to be 650 more 150 more bikes. So they've told us the numbers. So we're dealing with what, 24,000 here a year?
Profit.
Say it again. We had to spend 180,000 more in advertising over the course of the year, and we have what? We have 24,000 more a year in income. So, huh?
Fixed income, right? Because I mean, it could expand eventually. With mass marketing, you never know. I mean, $2,000 is just.
Well, look, I mean, we're not going to start getting into, well, this is going to turn into 8,000 units. I mean, that's a whole nother analysis, right? So we're thinking 650 is the amount of units more that we're going to sell. So it was 2,000 more a month, and I just turned it into 24,000 more a year. And so you're saying to me that what? You want this to be over how many years? Over 10 years or something? I mean, I don't know at what point this number gets big enough for me to take on this risk. I'm thinking $2,000 more per month with the risk that I'm taking on here because of what? The fact that I'm going to produce more bikes that I may or may not be able to sell. And now I'm going to be sitting here stuck with these additional bikes, right? All for $2,000 a month. I don't know. Okay, my only point here is I'm not trying to tell you do this or don't do this. When you're in business, decide for yourself. When it's your money that you're having to put up on the line to, make these extra bikes to do it, and some guy comes and tells you we're going to make $2,000 more a month, I think, then at that point you might want to say, well, you know what? Come to me with a bigger number, or come to me with a plan that's going to increase my amount per month. Or you may say that $2,000 fine. I don't know. I can't make that decision for you. Okay. Now, one thing that you would do is you would probably want to introduce probability analysis to this. You'd want to say, well, look, you're telling me 650 units more. What's the chances of that, right? Is there a chance that, somehow I'll lose sales at some point, or am I going to maybe increase it a little bit more and introduce a probability analysis? The only thing I'm telling you here is that it is not necessarily just this, well, it's 2,000 more, so do it. We do that in the classroom all the time, but the reality is you're going to take in a lot of other factors. That's all I'm trying to say here. Okay. Now, you come over, and for this one now, they want to sit here, and they see that somebody comes to them and says, hey, I'll buy 150 bikes from you. Okay? And we can do this and produce these 150 more bikes, but I should say it's not going to affect our current capacity at all. It wouldn't affect our capacity. We're going to be able to handle it without affecting our current sales. So we can produce everything we're still selling, plus we think that we can sell these 150 more bikes. So the question is, if we want to increase our profit by $3,000, how much should we charge for these bikes? Okay, so what happens? You just come over and start right here, you know you have to cover your variable costs, don't you? So you got to sell the bikes for at least $300 a pop, don't you? And then if you want to make $3,000 more in profit, then you could go ahead and do what? Just charge $20 above your variable cost. If you sell those bikes for $320, you'll make that desired increase in profit, right? Now, this is assuming that I've covered my fixed costs with the rest of my sales already, right? And I'm just now trying to cover the variable costs with these additional bikes, and I'm going to hit my profit by selling them for $320. Is there a problem with this analysis? Would you do this? Would you cut this deal? No? Yes? A lot of people say yes. You don't want to do it? Don't be afraid. Go ahead. Huh? Well, you just got $3,000 more in profit. Huh? Yeah, but before you did this, the factory was sitting there with nothing. So you're going to tell the guy no, so that those 10 machines over there can continue not to produce any bikes?
Well, I sold 150 bikes in one day. It's like, obviously that mass marketing is working. So I kind of need to find out that 4-day increase.
Okay, we're not writing fiction here, okay? I mean, we got to stick with the facts, okay? And I appreciate the fiction. I'm going to go in the fiction category here in a minute, okay? But right now, let's just stick with the facts of this question and what's happening. We're sitting here and we're assuming that the factory is sitting there. We've got a tarp over half the factory, right? And we're covering our fixed costs and we're sitting there, geez, if only we could fire up a few more of these machines, we might be able to make more money, right? And some guy comes and says, okay, take the tarp off of machine number 73 and go ahead and, produce me 100 and whatever it is, 100, how many bikes does he want? 150 bikes, right? Of course, we'll do it for this price because we'll cover our variable cost, and now we're going to have more that's contributing to our profit. This is going to be profitable for us, right? Okay. Say it one more time, sorry. Guaranteed sales with no risk. Well, hang on before the no risk because I'm going to go into a risk situation. You're right. I'm going to write fiction and introduce a risk here in a minute. But you're right. Right here at this point, we're just going to go ahead and take the tarp off a machine that was sitting there and increase our sales, right? Now, you want to say there's no risk. I'll write a risk into this. What happens if our customers that were buying our bikes for $500 a pop step up and say, excuse me, I just heard that you sold some bikes for $320. Why did you sell them to me for $500 when you sold them to the other one for $320? I want them for $322. And now we've got a problem because now we can't cover our fixed costs, right? So what's our reply to the guy? What's our reply? Do you want to buy 150 bikes? I'll give them to you for $322, right? Now, that's hoping that the guy hasn't already bought 5,000 bikes from us, right? We won't say that to him, but we probably would have given him a better price already, right? So my only point there is you got to be careful if you start to do that sort of an analysis, that sort of thing. You've got to consider, well, how could that potentially impact my customer relations, et cetera, right? That's all I'm saying is I don't know what the answer is. I'm just telling you that that would be part of the discussion, right? Okay. Okay, good. Let's go ahead then and let's consider this notion of the variable cost percentage. Some of the problems won't give you the contribution margin ratio. They'll give you the variable cost ratio. Can you hang with that? To get the what? To get the contribution margin ratio, and in a situation like that, they'd probably just be giving you this information here, not this part. They'd expect you to calculate the contribution margin ratio, but if they just give you in percentages the what? The variable expense ratio, you can back into the contribution margin ratio, can't you? It's just the difference between the two. Okay, 1 minus the variable expense ratio will give you the contribution margin ratio. Okay, all right, so let's go ahead and let's take a look at a couple more problems here. And let's see what we have where we are looking at our variable expense ratio, and we take that minus 1, doesn't that give me my contribution margin ratio? Okay, and once I realize that, they tell me what? They say if sales increase by 75,000, what will be the increase in my operating income if my fixed expenses are, where'd they give me the fixed expenses? Oh, okay, good. So we're going to do the analysis. The advertising campaign is going to increase 25,000. So what happens if 65% of each sales dollars goes towards my contribution margin? Then if I have an increase of sales in 75,000, my contribution margin is going to come up 48,750, right? I have an additional advertising cost of 25,000, so my profit should come up 23,750, right? Okay. Okay, good. Come over. Let's take a look at this notion of structuring sales commissions. Okay? This idea of structuring sales commission. And what they're saying to us here is that from a standpoint of a management of our sales staff, it may be a mistake if we base the commission on the sales price if we end up that the item with the higher sales price has a lower contribution margin. We want to sell the item that has a bigger contribution margin, don't we? Okay, so they go ahead and in this next example, oh, this is a sales guy? Okay, I was trying to figure out why are we showing a TSA agent to describe the sales situation. I see, he's selling our refrigerator. Okay, so what's happening? We're sitting here and we're doing what? We're sitting here and they're saying that they have these two types of surfboards. One sells for 100 and generates a contribution margin of 25. The other one, the turbo one, I guess, sells for 150 but only earns a contribution margin of 18. Now, if you're the salesperson, you want to do what? You want to sell this one for 150, and I was just making up in this example 10% sales commission. You want to sell this one because for every bike whatever this is, surfboard you sell, you get $15 of commission. Here, for every surfboard you sell, you only get $10, right? Meanwhile, what? I would be getting a higher contribution towards the company if I sold the cheaper bike, wouldn't I? So I would do what? If I'm managing this whole process, I would likely sit there and set up my sales commission based on the contribution margin, right? Or at least figure out a way to back into selling the one with the higher contribution margin if I'm not doing it strictly on contribution margin. Okay? Okay, good. So that's all they're saying there. All right, so what we're going to do is either keep going and finish through the homework quiz for this chapter, assuming this thing doesn't crap out on me right now. Because actually, I don't even have to do this. Did it already crap out? Not yet? Don't say anything. Okay. Let me get to... I'm going to discard anything I did here. And our options are to go ahead. I won't make you go through governmental not-for-profit accounting. I don't think you want that. But we can go ahead here and go through these questions right now, or we can take the break right now and come back and go through these questions. Your option. I don't care. Get her done? If I can get this keyboard to hide, please. Okay. And now I messed this question up. Ugh. Well, I just messed up the comma. That won't kill anything. So you just want to keep going? Okay. All right, good. So let's go ahead then and let's go through these questions and then we'll get out of here. Okay. So what's going to happen? We're sitting here and they tell us that we have this 42,000 of fixed expenses and they tell me that my contribution margin ratio is what? 61%. Or we could just go now. That's the other option. So I don't have to do this. I did these same questions this morning, and I did them the other day, the time before it. So I have no benefit by doing them again. I forgot about that option. So you want to go through them? Okay. Okay, good. So let's go ahead and let's take a look at them. And we say assume monthly fixed expenses do not change. What is the best estimate of the company's net operating income in a month where the sales are $126,000? So what do? Well, I take the $126,000 and I multiply that by the contribution margin ratio, don't I? And that's 0.61, which generates here, just peeking down, of 76,860. I know the answer's there, but I'm doing it in slow motion here by writing it. So that gives me 76,860, and then they tell me that their fixed expenses are already how much? 42,000. So I take that difference, that gives me $34,860 of profit that's left over when I have sales of 126,000, right? Using the contribution margin ratio for that one. Okay. Okay, good. Let's go ahead and scroll down here. This is on iLearn, guys. This file is on iLearn. Okay. And so now they're sitting there and they want to know the break even in sales dollars again. Okay. So I know if they want the break even sales dollars, I need the contribution margin ratio, don't I? So I take selling price. How much is the selling price? 170. I take my variable costs. Variable costs are what? 62.90. That gives me a contribution margin, and my contribution margin here is going to be 107 and 10 cents. Okay, so I have this 107 and 10 cents. By the way, make sure you sign in somewhere on here. And if you don't find your name at the end where you signed out for your test, write your name in and put the date. Otherwise, just sign out next to your name here if you wrote your name in. And if you're on the attendance sheet, sign out in the far column right here. Sign in the far column. And if you already signed on here, sign over that, because some people messed up and signed on the wrong column. But sign in on this thing. I'm only going to offer the opportunity for the higher score on that second midterm for people that maintain their attendance. If you got to miss a class for some legitimate reason, that's one thing. But if you're just going to check out of class because you can't stand the sound of my voice, take another class. Okay? But if you've got a legitimate reason, then we'll talk about that at the time. But make sure you sign in. If somebody isn't here today and they don't have a legitimate reason for not being here, and if they get a higher grade on the second midterm, that's great, but I'm not going to give it to them on the first midterm. Okay, I'm going to have a requirement with that for attendance. Okay, so we have this 170 minus the 6290. Somebody said that was 107.10 contribution margin. Okay, good. Now I want to get my contribution margin ratio for this problem. So I'm going to say 107.10 divided by what? 170 should give me a contribution margin ratio of roughly what? 0.63? Somewhere like that? Okay. Now that I have that, guys, and I know that it gets a little bit boring and cumbersome to do this, but I promise you, if you don't do it like this, you're going to get on the test and there's going to be a little wrinkle in the question. You're going to melt down because you're not going to know exactly what to do with it, right? So you always set them up then to say that my contribution margin ratio times my break-even sales dollars has to equal my fixed cost here, doesn't it? Right? So I go ahead and I just start to fill in the blanks. When you do this and you write this like this, you will be surprised how much it calms your nerves. Okay. And when I do the questions, I set them up like this because I don't want to waste a bunch of time spinning my wheels on a question trying to figure out where I went wrong. I want to quickly get this done so I can go take a nap. Well, you want to quickly get it done so you can get it done, not run out of time on the test, right? So when you do this, then you systematically start to become like a machine to answer these questions. And you sit there and you say, okay, I got the contribution margin ratio of 0.63. I don't know what my break-even sales are yet. That's what I'm trying to solve for. I know I'm going to get that. Break-even sales dollars. My fixed costs here are how much? $356,643. Okay, just do the algebra, break-even sales then. I'm writing down the next problem. Break-even sales then must be equal to 356,643 divided by what? 0.63. If it's not this answer, I have a problem. Is that the answer? Okay. Okay, good. Let's do this next one. Contribution margin ratio of Baginski Corporation is what? 0.53%, and they give me the fixed expenses, and now the only wrinkle here is what? Target profit that comes in. So again, I set it up. Contribution margin ratio every single time times the what? Now it's not break-even sales. I guess it's what? Target profit sales would be more better way of saying that. Target profit sales got to equal what? Got to equal my fixed cost plus what? Plus target profit, right? Now I just sit here and, okay, I take the information that the problem has given me. 0.53. I'm almost using a ninja approach on this thing. Just give me the information. 0.53 times what? Target profit sales got to equal, what's my fixed cost? 617,980 plus my target profit of 23,000. Isn't this fun? Target profit sales then has to equal 617,980 plus 23,000. Somebody got a total there for me. What is that? 640,980. So that number divided by 0.53, I'll go ahead and I'll write it just so we can see it. It's 640,980. 640,980 divided by what? 0.53 is equal to my target profit sales, which means my target profit sales better be this what? 1,209,396. Is that what you got? Okay. 640,000. You got it? Okay. Okay, good. It's all right. We're going to verify everything in here. Okay? In business, we verify everything. Have you ever seen that commercial for the Christmas stuff? They have Santa Claus saying to the guy, to the elf, he says, "Did you check it twice?" And the elf says, "No." And he says, "Then check it twice." Get it? Because the song, these guys check it. But we're gonna check it twice, aren't we? Okay, check it twice. That's how you make sure you get it right, right? So if we check it twice, we check it a third time if we're still not right. Okay, and you're gonna have plenty of time to check these if you sit there and you do this systematically. Okay, these next set of questions, I'm done with them. I invented these questions, and I made a mistake at some point in time, and every time I go back through these, I have to figure out what my mistake is, and I'm sick of it. I made some mistake with these, so just ignore these questions. We're not doing these. I made some mistake at some point in time, and I was trying to turn it in from a different question into this question, and something went wrong. And every semester, I got to remember what stupid mistake I made, and this is the end. I created these questions so I can destroy them. Okay, they're all gone. Don't worry about these. Goodbye. Okay, this one I do want to do. Froggy Company. Okay, now what's happening here? They tell me that Froggy Company is giving you the following information. Fixed cost per month, $2,500. Unit selling price is $100, and my variable cost percentage is 60%. If my variable cost percentage is 60%, then what's my contribution margin? Good. Contribution margin is 40%, right? And they want the what? Annual sales to break even. Again, guys, set them up the same time, same way every time. Contribution margin, what? Ratio times my break even sales is going to equal my fixed expenses, fixed costs, whatever, right? Okay. My contribution margin ratio here is how much? 0.40. I don't know what my break-even sales is. That's what I'm solving for. And I just grabbed the fixed cost here, 2,500, don't I? Okay. I take that 2,500. I divide that by 0.4. That gives me, somebody got a number for me here? Was it? Huh? 6,250, you say? Okay, now you look, and that is choice D, isn't it? But you got to be careful because they gave me monthly, and then they asked me for what? The annual sales, right? And so I simply have to multiply that number by the 12 months. How many months in a year? 12. It's the easiest question we're going to ask all day. So that's 12 months. So what do we get? 75,000? Okay. Question? Okay, good. Let's take a look at another one. I didn't make this up. Old MacDonald had a farm. Ha ha. Okay. And what? They had expected fixed costs for next year of 91,000. Projected sales price per bushel is 12. Variable cost is $5 per bushel. And they want us to say the break even in units if fixed cost increase $12,000. Who wants to set this one up? Okay, so we have the $12 minus 5. Great, thank you. Is what? Contribution margin per unit $7, right? Okay, now what do you want me to do? We take what? Well, the fixed cost they told me is 91,000, didn't they? But they want me to tell them what happens if it increases what? 12,000. So don't I have to increase it 12,000? So I take the 91,000 plus the 12,000. That gives me a total of 103,000. Thank you. So 103,000 has to be equal to, and I'm kind of violating my own rule here. I should have said what? Contribution margin per unit times my break-even units, right? Has to equal my fixed cost, which there's my fixed cost right there. So 103,000 is supposed to equal $7 times my break-even units, which I don't know what that is. That's what the problem wants me to figure out, right? I divide each side 103,000, divide each side by $7. Do I get an answer here? 14,715 exactly, or close? 14, but you round it up because you can't sell a fraction of a unit, right? And it was a 0.28. You think, oh, it should be 14, but no, we got to round up, right? Okay, good. Who wants to do this one now? With this one now, we keep the same original facts. Okay, we're going to keep the same original facts right here. Someday I'm going to figure out why it does this. Not today, though. I don't know why it loses itself. There it goes. Okay. No, it doesn't go. God, that's irritating. Okay, now I think it's there. Maybe I'm just too impatient with it. Do you think maybe I'm impatient? Okay, so what happens? We're sitting here and they're going to keep that same set of facts. And now we're going to just change up what? The situation where where we're adding the target profit here of 37,100. Okay, so who wants to set this one up? Target profit units. Target profit units times what? Times my contribution margin per unit has to equal my fixed cost plus what? Plus my target profit. Good. So now I'm sitting there and I say, okay, well, I don't know what the target profit units are. That's what I'm solving for. Times, and what's the contribution margin per unit here? $7. Now has to equal, and my fixed cost, and guys, we're just sticking with the original fact pattern here, which is what, 91,000? Plus what? The target profit they told me here is 37,100. So that means that what? Target profit units equals, what's the sum here? 128,100 divided by what? $7 equals 13,000? 18? 18,300? Okay. Now look, if this is the bulk of midterm 2, I don't see a problem. All you got to do is come to school. That's all you got to do in America. Okay? So now what's happening? Now we're sitting here and they say, what if the cost drops $3 per bushel? Well, if the cost drops to $3 per bushel, what's our sales price? 12. If our variable cost is what? That's our sales price. If our variable cost now has come to $3 per bushel, that means that my contribution margin is now what? $9 per bushel, right? Okay. And they now, notice, guys, are asking me to give them the sales to get a target profit, and they want it in sales dollars, don't they? So don't I have to use the contribution margin ratio if they ask me to sales dollars? What's the contribution margin ratio? How do I calculate that? Contribution margin ratio, how do I calculate that? 9 contribution margin divided by the sales price of $12, right? What did I get, 0.75 or something stupid like that for that? So now I have my contribution margin ratio, don't I? So I take my contribution margin ratio times my what? Target profit sales dollars, which is what this question is asking me for, got to equal my fixed cost plus my what? Target profit. And sometimes, guys, it's hard to have the discipline to set it up like this every time. Keep doing that. I'm telling you, at the end of the day, it's going to save you time. Because if you make a mistake, you can go back and say, I just added the target profit and the fixed cost together incorrectly. If you sit there and you just start cranking a bunch of numbers in your calculator and you don't come up with the number, then there's computer software that figures out once you make a mistake, what is the probability that you're going to get the wrong answer once you make your first mistake, right? I mean, they have all kinds of studies on that, okay? So you keep this all in front of you so that if you make a mistake, you don't panic. But my contribution margin ratio is what? 0.75 times my target profit sales, which I don't know what that is yet, in dollars, got to equal my fixed cost. Was it 91,000 in this problem, so I don't have to scroll back up? Plus what? 36,000? That means, what's the total of this? Okay, good. So you say 127,000? Okay, good. Divided by what? 0.75? Going to equal my target profit sales dollars? Still with me? Okay, so I go ahead now, and that means that my target profit sales dollars, just doing the math on this, got to be, 169,333, whatever, close enough for government work. Okay. The contribution margin ratio is what? Contribution margin divided by revenue, isn't it? I can do it by unit. I can do it in total, can't I? I can do it by unit. I can do it in total. If my sales price per unit is $10 and my variable cost per unit is $7, my contribution margin per unit is $3, isn't it? To get my contribution margin ratio, I simply divide the $3 by the $10. That gives me contribution margin ratio of 30%, doesn't it? If I have 100 units that I'm selling, what's my sales? $1,000. If I'm selling 100 units, then my variable cost is how much? $700. So my contribution margin total is $300, isn't it? If I take my total contribution margin and I divide it by my total sales dollars, do I get the same number? Do I still get that 30%? So all this question was saying, hey, if you know how to do it by unit, you know how to do it in total, don't you? Gives you the same answer. Okay? Okay, good. Now, this is the type of question here, number 21, that I'm talking about, that you get it on the exam, one like this, and if you've gotten used to now just mechanically saying, okay, fixed cost divided by contribution margin ratio, that's all I got to remember, that's going to give me the answer, you're going to run into a problem with a problem like this because it doesn't work like that for this problem. You got to set it up the way I talked about, and that then helps you to untangle and get to the answer, right? Okay, so they tell me that they have fixed cost of 100,000. They tell me that they have break-even sales of 100,000, and they want the profit if I have sales of 1.2. Now you have a problem here in that they didn't give you all the tools, it doesn't appear up front, to get the contribution margin ratio. So how in the heck can you solve this? Well, you're going to set every problem up the same, aren't you? So you're going to sit there and you're going to say, okay, well, I'm not going to panic. I know the contribution margin ratio times my what? Break-even sales equals my fixed cost, doesn't it? We've said that 52 times now, right? Okay, so then I'm going to sit there and I'm going to say, well, if that's the case, this problem didn't give me everything I need to get the contribution margin ratio, but it did tell me the break-even sales are 800,000, didn't it? Told me break-even sales are 800,000. And what? It also told me that the fixed costs are 100,000, right? So why don't I just go ahead then to get the contribution margin ratio by taking the 100,000 and dividing it by 800,000. That gives me contribution margin ratio of what, 0.125? And if I know that my contribution margin ratio is 0.125, I know that my contribution margin first goes to my fixed cost and then any profit, which is what this question wanted me to do, at a sales level of 1,200,000 right there. So I take the 1,200,000. Now, how did it turn to eraser? 1,200,000 times 0.125 is going to give me what? 150,000? Okay, so I got 150,000, but they want the profit, don't they? So I got to take off my fixed cost, right? Right? Hello? I got to take out the fixed cost off of this thing, don't I? To get my new profit at sales of 1.2 million? 50,000 is the profit? Right? Okay. Okay, good. I don't know what they did here. Oh, this is a different. Well, you can never answer. If you can answer this question based on what's going here, you're a genius. I'll give you an A in the class. Okay, so there's a problem with that question. I left out the facts. Okay. All right, let's look at this one. Okay. And they're telling me, well, we've already done something like this, haven't we? That what? We've got the let's just do it real quick. We've got the contribution margin of 80,000 at 5,000 units. That gives me what? That gives me a contribution margin per unit of 16. $16. And then they're just sitting here and they're saying, well, what if they sell 5,400 units? Okay, just multiply that times the 5,400 units and you get that answer, 24,000. Okay, then somebody gave me the wrong contribution margin per unit. 80,000 times 5 is what? Divided by 5,000? Impossible. $80,000 is the contribution margin divided by 5,000 units is $16 per unit. They are now going to sell 5,400 units. Gives me 86,400. Oh, I see what I did wrong. Yeah. And then what? So I have the 86,400. Okay, you guys are right. 86,400. Thank you. But it asked me for what? It didn't ask me for the contribution margin in this one. Here, I was thinking it was like those other ones we worked. Sorry, guys. Here it asked me for what? It asked me for the profit, didn't it? So I've got to subtract the fixed cost now that I know my contribution margin. Contribution margin first goes towards fixed cost and then what? And then profit, right? So I take off my fixed cost. I thought it was just like those other ones we were working. And that's going to give me what? Now it's 24,000? Okay. There it is. Okay. All right, let's take a look at this one. Bowie Corporation. And they have fixed monthly expenses are 21,000. Contribution margin ratio is 61%. assuming that fixed monthly expenses do not change, what is the best estimate of the company's net operating income when we have a sale of $74,000? So what happens? $74,000 is going to be my sales. My contribution margin ratio is what? 0.61. That means I have a total contribution margin here of $45,140. Contribution margin first goes towards fixed expenses and then profit. My fixed expenses are what? 21,000. That gives me here a difference of what? 24,140. It's almost very similar to the last problem, except what I had to do it here by unit before, but very similar to the one we just looked at. Okay. Okay, good. Let's look at this one now. This one's a little bit of a problem in the way it lined up. So let's just fix that. Okay, my fixed costs are going to be $35,000 for my manufacturing cost, and what, $60,000 for my non-manufacturing cost? Okay, and then my variable cost per unit are going to be $15 per unit for my manufacturing cost, and what? $10 per unit for my non-manufacturing costs. Now, the way you mess something like this up on the exam is you start letting the creative part of your brain take over. Don't let it do that. Okay? You got to keep that creative part in a cage while you're in here doing these things, and you got to sit here and say, well, look, I know that my contribution margin per unit times my break-even sales units has to equal my fixed cost, doesn't it? And if I know that, I don't start playing jazz with this thing and saying, well, let's see, let me take out the manufacturing versus the non-manufacturing. There's no rule that says that. It is what? It is my contribution margin times the number of units got to equal my fixed cost, doesn't it? Okay, so when I do that, then I know that my variable costs are what? $25 per unit. I know that my fixed costs are $95,000. If my variable costs per unit are sitting here at, if my sales price per unit is sitting here at 60 minus what? 25 got to equal $35 per unit. Am I doing my math right here? 60 minus 25 is 35, right? Okay. So now I simply sit there and I say, okay, good. $35 per unit contribution margin times my break-even sales equals, what's my fixed cost? $95,000. I don't get myself all tangled up in, do I get the operating? Okay. And so what happens? Now I just take the $95,000. Divide that by what? $35 per unit. Got to equal my break-even sales, which is what here? In units? 2,000 what? 2,715, you say? Okay, is that a choice, I hope? Okay. All right, let's look at this one. The Gene Company expects sales of $500,000, total variable cost of $200,000, budgeted fixed costs are $180,000. What is the break-even volume in sales dollars? If they're asking me for dollars, I know I need what? Contribution margin ratio. Can you give me the contribution margin ratio here? Can you give me the contribution margin? Sales of 500,000 minus what? 200,000 variable cost means I have a contribution margin of 300,000, right? Right? I take that 300,000, I divide that by 500,000. That gives me contribution margin ratio of 60%. Right? I can do it by unit. I can do it on the total. So now I take that contribution margin ratio times my break-even sales dollars. Got to equal fixed costs, right? Okay, what's my contribution margin ratio? 0.6. I don't know my break-even sales yet, but I'm getting close. Equals fixed cost of 180,000. I go ahead, my break-even sales then must be equal to 180,000 divided by 0.6, right? And what's that come out to? 300,000? Okay. Let's take a look at this one. So we have this McDonald Oil Company, and they're asking me here, what is the profit? So this is going to be a target profit question. So I'm just going to have to add the target profit to the fixed cost to answer this one. Now, when you see a situation where they ask you pre-tax, don't freak out. Some questions that I take from this are from a cost accounting book. And if I was teaching an Accounting 305 here at San Francisco State, when I teach it, I make my students calculate what is the after-tax income that they have to come up with. So they first have to figure out the pre-tax income, and then the next question asks them, what's the after-tax income? Because you do have to pay taxes in life, don't you? Okay, but we're not going to get into that in here. That's an accountant's consideration. Since we're not all accounting majors, you'll get to that in 305, okay? If you are an accounting major. If you're not, you'll hire an accountant to do that. Okay, so what happens? We have what? $1 million is my sales. My variable cost is how much? 600,000. That means I have a contribution margin of 400,000. I divide that by my sales price of what? My sales of 1 million. That gives me a contribution margin ratio of what? 40%? I set that problem up. Contribution margin ratio times my break-even sales dollars equals my fixed cost, right? Fixed cost, contribution margin ratio, I should say, is what? 0.40. My break-even sales dollars, I don't know yet. My fixed cost is, what are we looking for here? Oh, I mean, not fixed cost plus what? Target profit. What's my fixed cost? 200,000, right? And my target profit is what? 400,000. Even I can do that one in my head. That's going to be 600,000 divided by what? 0.4. Got to equal break-even sales dollars? Or target profit sales dollars, I should be saying. Target profit sales dollars. So that comes out to what? 1,500,000. Okay? All right, so your quiz is done. Your homework is done. You're done with the slides for Chapter 5. Next time we get into the slides for Chapter 6 and the homework for Chapter 6, which is going to be very quick, guys. I don't have a whole lot to say about Chapter 6, and so I don't have a whole lot to say about Chapter 7, to be honest with you. So what we're going to do next time is cover Chapters 6 and 7. And after that, we're sitting there and we're drilling on these questions over and over and over again. And this time, there should not be a problem. You should be able to come in here and crush these stupid little things. There is absolutely no reason to take this class and F it up by getting an F, is what I mean. All right? Okay, guys. I will see you next week. Can you turn that light? Oh, okay. I thought you were heading out. Sorry. No, you're cool. I thought you were going out. Oh, you mean what was the update going to be for?
It was like 2 right questions.
Was it just you or everybody?
Oh, well, for me it was 2, and then you said you were gonna add extra points for everybody.
Okay. Do you remember?